Hello, welcome back. Today's headline is Waiting for the Housing Crash. What is the cost of waiting? Welcome back. This is SeeWing Yi from the Yi Real Estate Network. So without further ado, let me share my screen. Let's go over this facts versus fiction about the housing crash. So, waiting for the crash, here's what is actually costing you. Prices rise around 4% per year on a historical basis over the past 100 years, over the past century, if you will. Every month, when people wait to buy rental properties, every month is a potential for lost equity. If the mortgage rates drop and you buy now, refi later. Okay. So you date the mortgage rate, but you marry the income property. Okay, that's how I look at it. All right, here's the waiting trap. How many Americans are sitting on the sidelines and why it matters? 31% of Americans actively want the housing market to crash, according to London Tree survey. Wow, really? 27% of renters say a housing crash is the only way they'll be able to buy a owner occupied primary home to live. The financial impact of waiting. Home prices have historically risen more or less 4% per year. Recent years far exceeded that. Of course, if you went through the pandemic housing boom a few years ago, many parts of the country have uh, houses appreciated like 30, 40, 50, 60, even 70% during 2020 to 2022, a mere two and a half years during the pandemic. Well, those are those are very, very it's not going to happen again. Let's hopefully not. So 4% annual home price appreciation. A $500,000 home today could cost 520K by next year. Prices double in a single decade from 2014 to 2024, despite COVID, rate spikes, and economic shocks. Price escalation never waits. Every month of delay likely means a higher purchase price. The, that gap can compound rapidly in a high demand housing market. Lost equity is real money. Each rent payment that you do not collect from a property you do not own on a tenant, you're not paying your bills, you are you're losing wealth. Okay. Home equity can be leveraged via HELOC for additional investments. If you have a home equity line of credit, if you're very fortunate to have this particular buckets of money, hey, by all means, use that money to start buying cash flow income property in a good growing market. So the decade effect, a $150,000 home bought 20 years ago, likely double, even triple or quadruple in some markets. Trust me, I've done that. And many of my hundreds of my investors have done that over the past 20 years. I've been consulting with my investors to buy income property throughout the US. Plus, not only that, plus not only equity appreciation, but early buyers now enjoy low monthly payments, relatively low, and the rents always rises in line with inflation. So your cash flow will go up systematically, gradually over time by owning a property. You're not going to get rich in real estate on income properties you do not own. So interest rates and buying power. High rates are real. Yeah, right now, according to Mortgage News Daily, I think the the mortgage rate is around 6.6%. Yeah, many of you are thinking, oh, this is high. Well, it's not really historically high. Pretty much in alignment with a historical mortgage rate, believe it or not. Today's around 6.6 mortgage rate as we speaking to you in the middle of 2026. However, a 1% rise in interest rates can reduce a buyer's budget by as much as 10%, especially in high cost markets, according to Jules Garcia, Coldwell Banker, Warburg, New York City. The raw move is waiting for the rates to drop before buying. While you wait, home prices in most part of the country, I know there are some housing corrections going on in certain parts of the country. By the time rates fall, you may face higher prices and competition from thousands of buyers who are also waiting like you. Quote, Black Friday, end quote, bidding war. Yeah, I like that word, Black Friday bidding war. The blood is in the street. The blood is on the street. Anyway, the smart move is buy now, refinance when the rates drop. Okay. Lock in today's price, build equity immediately. When rates eventually fall, refinance to lower payment. You could never go back and buy at today's price, but you can always refinance, right? The down payment trap. Oh, I'll invest in down payment while I wait. Sounds smart, but here's the math that kills it. Scenario returns. If you keep $80,000 in a savings in a money market, for example, you may get 47% annual yield, And if you use the $80,000 as a down payment, give or take, to buy income property, you will get, you get the income property is the most historical proven asset class in the world because you get appreciation over time, you get cash flow, rental income rises in line with inflation. You get tax benefits from owning real estate, paper depreciation, and all that. You get the tenants going to pay down your mortgage debt. They're going to pay off your tenants going to pay all your expenses for you. As a matter of fact, they are making you rich. Okay, it's called inflation-induced debt destruction. Your mortgage is your asset, is your friend. Okay, especially the 30-year fixed rate mortgage as an income property owner that you're supposed to get. All right. And then, of course, yeah, those are the factors. Those are the multi-dimension aspects of owning a rental property. All right. It's not just one dimensional. It's not only about cash flow. It's all the dynamics around owning income property. There are 4 to 5 pillars that you can benefit from it. All right. Home price risk. If you keep $80,000 in your savings account, you're exposed. If prices rise 4% on a 500K home, that's $20,000 per year of lost purchasing power. If you use the money to buy income property, you're hedged against inflation. You own the asset that's appreciating using leverage. Amazing, right? Using other people's money, OPM, getting a loan, getting a 20 to 25% down payment loan to finance your income property. Okay. You only use a portion of your cash to leverage into a property and have the mortgage company, the bank, whatever, leverage 3/4 of your payment. Okay. So equity. If you keep the money in your savings account, you're not going to build equity on the real estate you do not own, like I said earlier. But if you use a down payment to leverage to buy income producing long-term asset, like a single family home, the duplex, that's what I like, using a 30-year fixed rate mortgage That's the ideal situation. You can build wealth one day at a time. Long term, got to be at least a 10-year journey, right? Like as I mentioned before, leverage available the scenario. If you keep your money in a savings account in the stock market or money market, whatever, you have no leverage. You're just earning, 2 or 3% maybe. But if you use your available line of credit or cash available for down payment and finance the purchase with a 20 to 25% down payment, that's the benchmark, or using your HELOC, home equity line of credit, to as a down payment to buy a cash flow property and use the cash flow numbers income to pay back your loan, right? It's a wash. So it's a good risk. In hot markets, appreciation alone can wipe out years of disciplined savings on a measly savings or money market account in a mere 12 months. That down payment should be working for you in real estate equity, according to this guy. All right. Why timing the market fails? Real estate is not stock market, and quote timing end quote carries costs you can't click away. Okay, it takes time to buy, of course, finding the right income property, securing the investment loan. This process may take months. You can't click to buy the moment prices dip. The dip may never come, right? Home prices declined nationally only a handful of times in the past century. Waiting for a crash that doesn't come is a costly bet. In the past 100 years of the housing market, okay, this past century, there's only two crash. 1929 crash, right? The depression, 1929, and then the 2008 housing crash. That's it. Okay? Two dips, two financial real estate crisis in the past 100 years. All right? That's the facts. Okay? That is the facts. All right? So if you continue to stay on the sideline, you still pay rent. Every month you wait, you pay rent with zero wealth building effect. Renters in 2014 who waited for a quote better time, end quote, will pay much more in 2026 and beyond. Okay. Time in the market, not timing the market. Experts universally agree, quote, time in the market beats timing the market, end quote, for real estate. The best time to buy was 5 years ago. The second best time to buy is not now, yesterday. Yep, that's to recap, the best time to buy was 5 years ago. Second best time is now or yesterday. Don't let indecision cost you another year of equity. We help busy professionals invest in cash flowing properties across the country without the guesswork. All right, so that's all I have to say. To recap, waiting on the sidelines is not going to do you any good. Okay. You have the time you have on earth is so precious. Okay. Okay. Invest over time, stay invested, buy income property, get off the sideline, and invest for the long term. Waiting is not the right thing to do. All right. So that's all I have to say. If you receive any value whatsoever from this video, please like and subscribe to my YouTube channel. And furthermore, please, if you have not already done so, put your email on my website and put your email on my newsletter database, and you will become a free member of our real estate investment community. So on a weekly basis, in your email inbox, you will receive free contents around real estate investing, around real estate economics, the housing market, updates, everything else. All right. Thank you so much for watching. This is SeeWing Yi from the Yi Real Estate Network. Thanks for watching. I'll see you next time. Bye-bye.